Dell is up 221% in 6 months and sitting 2% from its all-time high of $429. The question isn't whether the quarter was good. 88% AI server revenue growth answers that. The question is whether you're buying growth or buying someone else's exit. At $421, with a trailing PE of 48x on 5.2% net margins, you're paying a premium price for a razor-thin business. Dell is not a startup. It's a 41-year-old hardware company that just posted $113.54 billion in revenue, 39.5% growth in a sector most analysts wrote off as mature. The engine behind that number is AI-optimized server infrastructure. Hyperscalers need physical rack systems to run large language models. Dell builds them, powered by NVIDIA GPUs. That's a direct position on AI capital expenditure, not a derivative bet. NVIDIA's 85.2% revenue growth and Microsoft's accelerating infrastructure spend confirm the buildout is real and multi-year. Dell sits at the supply side of that demand. The last time Dell approached a 48x trailing PE was 2021, driven by pandemic PC demand, a cyclical surge that collapsed as soon as consumer spending normalized. AI server demand is structurally different. The forward PE compressing to 24.5x signals earnings are growing into the valuation, not inflating it. 6 months ago, Dell traded at $131. Today it's at $421.82, a 221.71% move. That gap matters because it tells you how much future growth is already priced in. The trailing PE sits at 48.54. For context, Dell's hardware peers have historically traded between 10 and 20 times earnings. This multiple implies Dell will sustain exceptional growth for years without interruption. That's a high bar for a company with a 20.13% gross margin. When you're earning 20 cents of gross profit per dollar of revenue, there's no cushion for a supply shock, a demand miss, or a pricing war. Dell's own Analyst consensus target sits at $220.26, 47.8% below where the stock trades today. That's not a minor discrepancy. That's a near halving, according to the people who cover this company most closely. Dell traded at roughly 8 times earnings as recently as 2023. The current 48.54x multiple represents a full re-rating, one that assumes the AI server supercycle is both real and durable, and that Dell captures it profitably. The stock's 52-week low was $106.38. The distance from that low to today's $421.82 reflects optimism, not fundamentals catching up. Net profit margin is 5.23% on $113.54 billion in revenue. That produces thin absolute earnings for a $274 billion market cap. The math only works if revenue and margins expand simultaneously and rapidly. The easy money here was made by someone who bought at $106. At $421, you're buying their exit. Forward earnings are the core of the bull argument here. Net income is projected to climb from $4.59 billion in fiscal 2025 to $5.94 billion in 2026. That's a 29% jump in a single year. On forward earnings, the multiple compresses to 24.5x. That is not an expensive stock if the growth trajectory holds. Revenue tells the same story. Dell is projected to cross $113.5 billion in fiscal 2026, up from $95.6 billion, nearly an $18 billion revenue expansion in 12 months. A 39.5% revenue growth rate at this scale is not common. This is not incremental improvement. The demand signal from upstream suppliers supports it. Microsoft, a major Dell customer, posted 18.3% revenue growth with explicit commitments to expand AI infrastructure spending. These aren't projections, they're reported results. For historical context, in 2016, Dell's post-EMC acquisition era traded at roughly 6x forward earnings under private market constraints. The current re-rating to 24.5x forward reflects a structurally different business, one with server and AI infrastructure now central to the thesis, not peripheral to it. The bull case is internally consistent. Earnings are accelerating, customers are spending, and the forward multiple is pricing in growth that upstream data is already confirming. Compare that to Microsoft at 22.84x forward earnings on 18.3% revenue growth. Dell is growing revenue at 39.5% and trading at a negligible premium to one of the most mature software businesses on the planet. That gap shouldn't exist for long. The 5.23% profit margin is real, but it's not the story. Dell's revenue base is $113.54 billion. A single percentage point of margin expansion adds over $1.1 billion to net income. The operating leverage is already showing up in the numbers. Wedbush's Dan Ives called the AI buildout a third-inning story. If that framing holds, Dell's infrastructure revenue runway extends well past current analyst consensus. The market has already moved past where the consensus is pointing. Are you buying Dell at current levels, or do you think the move has run too far ahead of fundamentals? Drop it in the comments. Gross margin at 20.13% leaves almost no room for error. Compare that to NVIDIA's 74.14% gross margin. Dell is assembling servers, not designing the chips that matter. When AI infrastructure spending decelerates, thin-margin assemblers reprice first and fastest. Dell's AI revenue engine depends almost entirely on NVIDIA GPU supply. Any export restriction or supply disruption doesn't just slow growth, it removes the primary catalyst entirely. In 2016, Dell's hardware margins compressed sharply as enterprise refresh cycles stalled. The stock dropped over 30% before recovering. A deferred order is not a canceled order, but futures markets don't wait for clarity. The bull case is real. The risk case is equally real. Which risk concerns you most, margin compression or NVIDIA dependency? Drop it below. The question isn't whether Dell benefits from AI infrastructure buildout. The question is whether buying at 4 times the analyst target is how you capture that upside. The math argues otherwise. Are you buying Dell at current prices, or waiting for a pullback below $380? Drop it in the comments. The easy money was made at $106. The question is whether $422 is the entry point for the next leg, or the exit. I think it's the former, with a 24-month horizon.